Hi, I'm John Persinos, Editorial Director of Investing Daily. Welcome to my video presentation for Tuesday, January 18. To view our full range of products and services, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. The new year started with volatility and downward momentum in the financial markets. Those choppy conditions continued last week as all eyes turned to fast rising inflation. The startling surge of inflation was a reminder that inflation is the key factor in the year ahead. The U.S. Bureau of Labor Statistics reported last Wednesday that the Consumer Price Index for all urban consumers spiked by 7% in the year through December, and the core rate, excluding food and fuel, by 5.5%. Take a look at the following chart from the Federal Reserve. That's the highest rate of headline CPI inflation since 1982 when Ronald Reagan was in the White House. Much of the rise in prices was attributable to durable goods inflation. Notably, prices of used cars and trucks soared in December on a year-over-year basis by 37%. This uncomfortably hot rate of inflation affects monetary policy, bond yields, consumer spending, and sector leadership. By spending more time at home, consumers have reduced their spending on services. Services such as travel, eating at restaurants, drinking in bars, attending sporting events, going to movies, exercising at gyms. Instead, they're buying more durable goods, such as kitchen appliances, household items, electronics, sports equipment. This shift in consumer behavior from services to durable goods has put greater strain on the supply chain, causing shortages and fueling inflation. These trends are making investors apprehensive, as you can see from the following table. Take a look. The major U.S. stock indices finished last week in negative territory as the pandemic, inflation, and more restrictive Federal Reserve policy weighed on investor sentiment. But crude oil prices continue to rise as investors continue to bet on economic growth, and the OPEC Plus cartel production cuts remained in place. I expect higher inflation to ease in the coming months as supply chains get back to normal and energy prices plateau. Stocks have been under pressure, but we haven't seen major sell-offs, and that's because expectations for high inflation are priced into equities, and corporate profits, they're still growing. That's why I think markets will remain resilient, albeit with bouts of choppy trading, even in the face of elevated inflation. Fed officials are now calling for a rate hike as early as March. With the recent drop in the unemployment rate to 3.9%, the Fed has leeway to tighten. The imminent beginning to the Fed's tightening cycle, the sixth over the last 40 years, is a watershed that represents not just hotter than expected inflation, but also the robust nature of the economic recovery and jobs market. How should you calibrate your portfolio under these conditions? To pick the right sectors, you need to know where we stand in the business cycle. What's helpful to you as an investor is that certain sectors of the economy have typically outperformed or underperformed the broader market, depending on the stage of the economic cycle. The economic cycle is the rise and fall of activity, which historically has followed a recurring and predictable path. It starts with early expansion, characterized by rapid growth as the economy emerges from a downturn. Growth evolves into maturing expansion as companies hire more workers, consumers spend more money, wages rise, and inflation kicks into gear. We're leaving the fast growth early cycle. The Fed's evolution from emergency stimulus to tapering to rate hikes, it indicates that the economic recovery has progressed to the mid-cycle phase. As you can see from this graphic, mid-cycle sectors, e.g. basic materials and industrials, make the most sense now. The mid-cycle is typically the longest phase, characterized by moderate growth. Economic activity gains momentum, credit growth is strong, and corporate profitability is healthy. In the late cycle, which precedes recession, growth is slowing and stock prices get dangerously overvalued compared to earnings. Sectors that historically outperform during the late stage include energy, healthcare, and consumer staples. Timeless laws of finance and economics always hold true, regardless of the era. Paying attention to the economic cycle historically pays off. But right now the problem is the pandemic has made it difficult to ascertain the exact state of economic growth. We face a lot of unknowns in the current year. To guide you through these perilous times, our analysts have compiled a special report of 7 shocking investment predictions for 2022 and how to profit from them. To download your free copy, just visit the URL that you see right now on your screen. Well, that does it for now. Thanks for watching. Stay invested and please stay safe.